know how to calculate your cash flow? Do you save a regular portion of your income each month? Do you have an emergency fund which you can rely on for at least 3 months in the event that you lose all your income?
No.
No.
Nah.
No?
No. In order to address the issue of people unawareness towards their own cash flow, we are paying a visit to Mr. Kang, a financial expert, to learn more about this issue. What can you share about financial planning?
Financial planning involves setting one's goals, gathering one's investment data, and evaluating one's financial status, and then planning to reach the desired goal. Proper and adequate financial planning can result in one being able to live a comfortable life without having to worry about cash flow. So, what is cash flow? Cash flow is one's total inflow, such as salary, CPF, and investment income, minus one's total outflow, such as expenses, debt repayment, and income tax. The result is your net cash flow.
So can you tell us more about cash flow?
Certainly. In financial planning, we will use a few ratios as guidelines to measure the health of our cash flow. The first of which will be the basic liquidity ratio. It is made up of one's cash and cash equivalents divided by one's total monthly outflow. The result will give the number of months a household can survive in the case of the lack of income. An example will be the unemployment of the sole breadwinner. A household should survive at least 3 months, and one way to increase the ratio is to increase one's saving or to liquefy assets to convert to cash. Another ratio is the savings ratio. This is measured by one's saving divided by his total inflow. It needs to be at least 10%. Some tips for saving would be to put aside a sum of money at the start of each inflow. In other words, save before you spend. One should also be prudent and wise and avoid unnecessary expenditure. Last but not least, there is also the debt service ratio. It is one's total annual loan repayment divided by one's total inflow, less CPF contribution. It should ideally be 35% or lower. One way to improve on this ratio would be to increase inflow or to pay off all outstanding debts at the end of the month and not allow it to roll over, resulting in a deadly snowball effect of accumulating interest. Shall we? Cheers.
Thank you, Mr. Kang, for sharing with us your professional knowledge on cash flow management.
You're welcome.
I'm sure you guys have benefited greatly from this program. Thank you.